Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I was asking some questions on Twitter. The question was, is real estate in a bubble? Why or why not? Just trying to get some opinions to see what other people think outside of my own. And surprisingly, a lot of people say yes. It's, uh, a lot of people, they always go back. It says, as Rick Rule, the billionaire says, the cure for high prices is high prices. Well, what if we don't have high prices? What if these prices are cheap? The reason I say that, I'm just going to go back to this real quick. Get me out of the way here. From 1970 all the way to 2000, the composite affordability index was below 147 basically the entire time. I mean, there's a couple years that was above it. And the index went all the way down to 69, about 69, 80. There's an 80 here for that year, a 69 there, 69, 83. And this is when house prices and mortgage rates went up together. Mortgage rates went all the way to 15.4%, while house prices from 70 to 1980 over doubled. They did over a 2x during that time frame. So not only did the house prices double, their mortgage rates also about doubled. And now the Housing Affordability Index, this is from 2021. I know this dropped down a little bit. I think it's down around like 140 or something like that, if I remember. And it's basically on the cheap side compared to history. 140, it briefly touched 140 in 1998, which was cheaper home prices with a little bit lower mortgage rates compared to maybe history back here. But maybe we don't have as high a prices with the interest rates where they're at right now anyway for in terms of affordability. But as prices go up, affordability should go way down. That's the whole point of trying to price people out of the market is you need your affordability to decline. So there's that aspect. It says what you said, it doesn't mean that is a bubble. It could just stop supply of new homes for a while. As far as I know, a bubble is when supply exceeds demand. There is plenty of potential buyers on the market, and I agree with that. We've got a lot of buyers out there, and there's no supply. So I don't know how we could be in a bubble until that dynamic reverses. Now, I think a lot of people think that the supply-demand dynamic between each other is just going to overnight change. And then we'll get all this supply and the demand doesn't want to buy anymore, and that interest rates are the driver of it. I don't think interest rates are a driver of the market. I think they are a laggard and they are following what the market is doing. Now, interest rates is going to slow down lending for some people. If I'm in a situation myself, which I was back years ago, where I had to choose between rent or buy. And right now, if I had to go into that same situation today, and I said, okay, am I going to rent a house or buy a house? I would buy it in a second. Most of the people that I know are buying homes and not renting them. Why? Because rent is far more expensive than it is to buy. I would have to pay probably $3,000-ish to rent a house. I could buy the same house for far cheaper than that. So we're continuing, at least a lot of people in this city are probably going to buy instead of rent because if they can get the house, it's very difficult to get a house because they go in like seconds and the inventory is very low. We're talking like a quarter of a month low, which I honestly, guys, I have no idea how house prices are going to go down until the inventory goes back up. It's going to take at least a few years, and I don't think it's going to be as there's no bubble there, in my opinion. A bubble is when you have easy loans getting out there, and your inventories are starting to skyrocket. That'll tell you that you're in a bubble, and that's what we're going to watch and see to see how the inventory reacts. If we get a whole bunch of inventory and it continues to go higher, which I shouldn't say continues, switches to going higher, then I would say I would swap my mind and say it's in a bubble. If we get to like 10 months of inventory, I don't know how we're going to get there yet. I think we're in a very low risk area for that happening. It says it is very high valuations. Where are you getting these valuations from? Um, and the reason I'm going through this is I'm just kind of describing how I look at things. Maybe that's valuable to some people, maybe it's not. House prices have never been have been very rarely cheaper in history against gold. So house prices priced in gold are actually very cheap. And if you look at how house prices are priced with low interest rates, they're cheap as well. So there's been so much money created that the actual, if you were to do an M2 money supply in relationship to home prices, you'd probably see that that's cheap. There isn't, if you look at the stock to real estate ratio, that is off the charts cheap for real estate. I don't know when you guys say it's at very high valuations. What are you actually saying? The price has gone up? That's not value. The value is cheap against all other, at least assets that I price. That's your ratio analysis. That's what we've learned on the channel. So if real estate is actually very cheap in valuations, and let's say they can't raise interest rates, they're going to keep them below a certain amount. That means your only equalizer in the price is not rates and price. It's only price if they hold rates pretty low. So if they don't let rates go above a certain amount, 5% or something like that, then they're going to have the house price is the only determining factor of balancing the market. If they do that in the future, we'll see. Since I think the price will stay elevated for the remaining of the decade. Says this does seem like a reasonable theory. They fall in real terms, but stay fairly steady. Guys, real estate's already fallen in real terms, like massively. It is very cheap. And people are going to find that out when money goes to rotate over, the investors are going to buy this up. Because if you have millions or trillions of dollars that you have to place somewhere, where are you going to put it? If you have a rising interest rate environment, it's not going to stay in bonds. And it's probably not going to stay in tech stocks and all those. And there's a bunch of money over there. Many, many trillions. Where's it going to go? If the dollar remains strong, they're going to want to stay in dollar assets, but it doesn't mean that the dollar is going to be good in absolute terms. So when you look at it from absolute terms, if it's going to have inflation, they're going to want to go into an inflation protected asset. Real estate's actually one of the best inflation protected assets because you can take a loan out on it. And then on your original amount, if that entire amount goes up, you actually get a really good return. It's one of the, I would say, easiest, least risk ways to make a lot of money. And especially if you're going to rent some of this stuff out, I mean, it's actually a really good bet. And a lot of people make a lot of money in real estate. And I know someone had written in here, I don't know if I have seen it. They said that they made the comment that home buyers are not as smart as the derivatives market, like the bond market and whatnot. But I think the bond market is just reacting. They're not the trend setter. They don't raise interest rates before they need to raise interest rates. They're just chasing and following. So they may be smarter and they may be sniffing things out. And it's not necessarily being smarter. They just have insider information. The banks are the ones that set the policies. They know what happens before it's going to happen. It's just insider information, in my opinion. But real estate, in my opinion, is going to be robust. And I don't know the real estate market in some of these other ones, like in Australia. I don't know that one. I know Canada's had a pretty good rip, and I think it's going to continue higher until there's a balance. There has to be a balance. I know their inventories are incredibly low up in Canada. And what that means is that the interaction between the buyers and the sellers are eating through the inventory, which means that prices are too low. That's the way that I look at it. It says prices in a bubble fueled by cheap loans, which will correct if said rates rise, but at the same time in a structural deficit. See, if you're in a structural deficit, and even if rates rise, home prices are going to continue to rise, which will resolve through more builds. Now that I do agree with. Results may in maybe high prices, low ownership rates. Well, the ownership rates are already very low for millennials. They're going to continue to pile in and buy if they want to live by themselves, either renting or buying. Way too much demand, little supply. There will be a bubble when the average person stops complaining about home prices and resigns to renting. Lack of demand will cause a correction. Well, what exactly are they going to rent? If we have not enough homes, where are they going to rent? Are you talking like they're going to go rent an apartment somewhere? And if those are all full, where do you go? If you have a family, what do you do? You're going to have to rent a house, and renting houses here are incredibly expensive. I would rather just buy. It's cheaper to buy here than it is to rent. I don't know. I'm curious if we're in a weird situation where there's a shortage of housing, but also houses are expensive compared to wages and the past 10, 20 years of interest rates. So I already showed you the home affordability index. We've never been cheaper. It's cheaper today than the 50 years before the 2010s. So what makes you think that we are expensive? If the affordability index is cheaper and when you price housing against all other assets, it's cheaper, then how is this expensive? Are we just using price as a determining factor of value just because it's gone up some? I'm trying to break everybody from their molds. I'm trying to say, look, this paradigm that everyone's using to price assets is wrong. And maybe the house prices do go down. We'll see it in the inventory numbers. We'll watch it. So, regardless of your long-term investment, real estate is heavily influenced by what some dude says, Jerome Powell. Then your risk is too high, so you better be in a $1,500 or less per month rental properties so that we can weather the storm more easily. There's no $1,500 a month rental properties here. I mean, you're talking like one bedroom apartments are like 1,200, 1,300 for a studio. Sorry, it's not one bedroom, studio. That might be a one bedroom apartment in a nice location is $1,500, $1,600, $1,700 a month. And then people say, well, you're just going to have to move. Well, what if your job's here? I don't know. We'll see. Ask yourself, how much lower can interest rates go? Lower rates and government regulation have been fueling higher prices. No, it's supply and demand. It's not rates. Rates just follow whatever it goes. And now rates affect the affordability, but affordability goes out the door when your supply goes away and your demand's far greater. Affordability has to get less affordable. The future isn't written and it's hard to predict. I'm thinking we're either in one or not far from it. Too much debt, inflation is killing purchasing power. Now, guys, if the government has a lot of debt and they have to inflate this debt away, let's say they're going to choose to inflate. When that money comes into the system, and I've heard this before, I think Lynette Zhang said it, that there's going to be a hyperinflation. Maybe not here. She just made this comment. She said that there's going to be a hyperinflation and that home prices were going to go lower. I don't know how that's incongruent. That doesn't make any sense. I'm sorry. It just does not make sense. If we have a bunch of inflation, the best thing you can do if this were a thing, I'm not saying to people to do this, but if we knew that a hyperinflation was coming, the best thing you could do is leverage up on the most amount of debt possible. Buy as many homes as you can, buy as many of whatever you can, and then let the inflation pay it all down. The only thing that would be a negative is that your maintenance costs would go up in a hyperinflationary environment. And sometimes if you have supply chain issues, it would be harder to maintain these things because you don't have the very things needed to fix or maintain the properties. But the best thing you could do would be to go into massive debt and align yourself with the government, who is also massively in debt, which means they have to print the money and have inflation. I don't know how you could have inflation and have home prices go lower. That makes no sense to me. Zero, none. If you gave me a whole bunch of money and home prices went lower, well, I would buy some like ridiculous place to live in. Why not? Oh, but the taxes would go up under that scenario. It's hyperinflation. Who cares? All my assets would go up. Get as much debt as you possibly can and then let them pay it off with the inflation. Now, I'm not saying to do that because I don't know if a hyperinflation is going to come. I don't know. But if you're going to align yourself, I would align myself with those who need to inflate the debt away, which is the government. And I think that's probably the area they're going. And I don't know of a home price, like, I don't think we've ever seen a real estate crash in a hyperinflation event. They've all gone through the roof. Maybe way at the end of it, it crashes in real terms or something like that. Everything's in a bubble except commodities because bonds are in a bubble. When long duration yields start rising, valuations will crash. I agree with that. That's 100% true. But I don't think house prices will crash because that money's going to rotate over from bonds and stocks into something, either into commodities and real estate. Real estate's going to be the acceptance of a whole bunch of investors getting their money out of bonds and these other assets. That's kind of what I'm thinking. Relative to gold, money, no, they're not. This person knows exactly what's going on. Relative to income, yes, it's completely dependent on if the government decides to fiscally obliterate the currency. It's the rich versus the rich at this point to see who ends up with actual money. That's actually a really good response. Good job, Looking Glass Cube. No joke. Yes, maybe no. There are thousands of markets in 3 classifications of cyclical, hybrid, and linear. A 2 million condo in New York City, yes. 2 million in upstate New York suburb, no. Or maybe $2 million a farm in linear market where cities are losing population, no. Hard to say. I've heard some say we have lots of inventory and a bunch of defaults are coming in our future, so it's hard to know who to believe. And I agree. This seems to be one of the most the topics that are the most debated. But my opinion is I'm going to be a bull until the housing starts to decline. And remember, it's the volume of housing starts that determines how much money's coming into the system. So it's the loan amount times the volume, how many new homes are being built and closed on. And right now we don't have the inventory. So I'm going to remain a bull until the inventory increases to some amount. And that's how I look at it. I don't try to make projections based off of what some of these people are doing. What they do is they say, well, interest rates are going up, therefore there's going to be a crash. Well, you have to see it in the inventory, and the inventory doesn't move that fast. What I mean by moving that fast, it takes time to build it up. So we'll see the inventory build if we get an inventory build. We haven't got an inventory build. It keeps going down and lower, which means it's getting tighter and tighter. And we'll see how the interest rates impact it. It's going to be interesting to see all this. And I can't wait to see it, because it is part of the thesis on the channel with basically the real estate starts with inflation coming into the mix will increase interest rates. And an increasing interest rate environment will have money move in this system. And that money moving is going to come back to commodities, real estate, and precious metals, in my opinion, for inflation sensitive. They want to go into inflation protected assets. If you guys like the give me a thumbs up if you like the content. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.